Hello and welcome to Gravitas Wins Conversations. I'm your host, Joseph Jude. Today, we are discussing one of the crucial aspects of wealth building, investing for the short term. My guest, Regi Thomas, until recently, he was a senior vice president at Motilal Oswal Financial Services. Recently, he has started his own private investment advisory. In today's discussion, we cover strategy, pitfalls to avoid, and actionable insights for you to help build this wealth. Before we jump in, a quick request. Remember to hit the subscribe button, leave us a review, and share this episode with fellow business leaders. Hello, Regi. Welcome to the conversation.
Hi, Joseph. Hi. Thanks for having me today.
Regi, let's start with this. Can you explain the concept of short-term investing and how short is that short? Is it time-based, amount of money needed? Can you walk us through?
I think a short answer befits short-term investing, isn't it? So, actually that term, Joseph, that you just used is actually oxymoronic. Now, investing itself means over a longer term. And when you put the word short-term along with it, it becomes a combination of opposites, right? Today, however, the world looks at short-term as short-term meaning from a couple of hours to maybe a week or maybe a month. That is short-term. There is also ultra short-term, which means that you make a transaction for within a day. So within a working day. So you buy something at about 11:30, you exit that position because it has yielded and price appreciation, and you get out. That's ultra short-term business. So today's short-term ranges between, let's say, a week, a month, to about ultra short-term, which is a couple of minutes to a couple of few hours. And technically, short-term investing, as we all like to use it, is oxymoronic. So be very careful when you use it.
Okay, thanks for that clarification, Regi. I understand what you're talking about. The audience for this particular podcast is IT executives,
Right.
and they are not traders. They are not, on that particular aspect of it. So what I'm looking at is, let's say, for example, I get a bonus.
Yes.
And I need that money at some point in time. I mean, a couple of months later.
Yes.
But within that month, can I put that to productive use?
Perfect. Right.
So that's what I'm looking at. That's what I'm talking about. And again, the terms might be a little different. I mean, please correct me.
I get it.
Whatever terms, but that's what I'm looking at.
No, I actually, Joseph, you're not the only one in the world who have heard using this term. This is common, even for experienced, seasoned traders. People use this term. Now, to answer your question more specifically, somebody receives a bonus. I don't need that money for a length of time, so I'm willing to deploy it somewhere. Yeah, there are strategies that are available. Like, for instance, you can look at ultra short-term mutual fund investments. You could look at specific stocks that we believe are likely to rise in the near term, owing to their weightage on the economy or the propulsion that they give, the momentum that they offer to the economy, and therefore those are possible short-term plays that people can actually look at. Yeah. So from your standpoint of view, I think these would be the two other alternatives to putting that bonus into a fixed deposit that people can actually look at in the short term. Yes.
Okay. So let's talk about some of the avenues. You already touched upon FD.
Yeah.
I mean, the first thing is put it in the bank and forget about it.
Yes.
Okay.
Yes.
Then you touched upon FD.
Yes.
You touched upon MF, mutual funds.
Yes.
And then some specific stocks.
Right.
Okay.
Right. Okay.
Are these the avenues? Can you compare them with for the short-term fund that I have?
Yeah.
Can you compare them and then say, okay, at what point should I do what?
Perfect. Okay. Now, we call this the ladder of risk. So this will put a lot of perspective into people that are trying to listen, right? The higher you go up to the ladder, the harder you fall. So, if you get that concept into your head, it's very easy to understand from where I'm coming in, right? So, which means the best returns, which means the highest point in the ladder also offers you the best returns, but it also increases your risk, which means your height from the ground is going high. So you fall, you could hurt yourself harder. Now, when you consider that picture and then you sort of superimpose your thoughts onto that, you will find that at the lowest rung of the ladder, you have fixed deposit. So that is low risk. I mean, all of us know that we believe the banks are safe, so you earn maybe 5-6%, almost zero risk, unless the bank goes bust. There is technically no risk in that, right? So that is the lowest level. You move one level higher, you have mutual funds. Now, why do we talk about mutual funds? Because IT professionals or people involved in other businesses do not have the expertise, do not have the time to build the skill sets or to analyze something that they would want to put in. So they bet on the expertise of the fund manager, put it up, help the fund manager manage that money, let him do what he has to do. It's probably 3-4 rungs higher than the FD. So your returns get substantially better. You could average about 8 to 12, maybe 12 to 15% in a year if you stay that long. But obviously, the risks are also going to be higher because you're going to be investing that into market related investment, which means stocks. The third level on the risk ladder is the highest, okay, where you go into stocks directly. So you pick up now, for instance, we probably understand that AI is going to be the future. We are already into that mode. So we understand the importance of AI investment. So we look at stocks that are dealing with AI. For instance, if Chat GPT were listed today, for instance, if there are other AI offerings that were listed that we could put our money into, we get into those stocks because we know that they are going to be the future. There is going to be a price appreciation. Electric vehicles, for instance, we know that the demand for EVs are actually growing. So we look at that for a short term, look a short term price appreciation, put it into that, go. The downside here is that now we've gone up the ladder. Our risk levels are also high. And why do I say risk? Because if the perception with which we're investing does not really translate over that short term, either your money could just stay where it was at that investment level, it could even sink a little lower if the economic conditions change. So I think this is probably the ladder of risk and its balances with its returns when you look at short term investing per se.
That's a fantastic metaphor, Reggie. Now, when we are looking at this ladder of risk and what are the
Yeah.
investments instruments that you're talking about for the short term, again, investments, what should we look to optimize? Liquidity, returns, preserving the capital, and is it possible to balance all of them?
When you say investing, I'd like to draw a parallel to the agrarian system. This is like farming. So when you say I'm a farmer, right, there is no farmer that sorts of plants his crop at 6 in the morning, expects to harvest it by 12, and then have his lunch with that crop by noon. So that doesn't happen. So what is it that plays here? Understand the most important thing that all of us need to comprehend is the concept of time. Time is what causes appreciation. If you put your money, or if you sort of sow your seed into fertile ground, you water it, you care for the weeds, in due course, with the monsoons coming in, you will have a decent harvest to do. So keeping this in mind, look at stock investing. You put your money into a stock, you need to give it time to grow. So if you're looking at time to grow, I think the closest that I can draw up for a short term is a period of about 90 days, Joseph. I think
Okay.
one quarter to another. Why do I say a quarter? Because companies come up declaring their financial results once every quarter. So you have 4 quarters in a year. So once you do that, you pick up a stock. So one is the most important concept of time, which has to be defined, which is 90 days. The second thing that you look at is the quality and the nature of the stock or the investment that you do. FDs and MFs are no-brainers. But when you're looking at stocks, yes, either it's got to be EVs, maybe it's got to look at AI-related stocks, maybe something that's, for instance, crude today is hot because of the war and supply constraints that Saudi Arabia has come up with. So you could look at crude refining stocks for the short term. Now, these are possibilities that can work. Three, when you're looking at such 90-day periods for investment, it's also important to understand that something that is of mass demand. For instance, crude is something that we cannot live without, right? Crude is something that all of us need, whether it is to move cargo ships, whether it is to move our vehicles, you need it. Electricity generation, we can't live without power. Even this podcast is being powered because of that. You can't live without your internet. You can't live without your, stuff like that. So something that affects the mass in a huge number, definitely a good stock to buy for the 90-day term. So that sort of brings down your risk perception when you actually put in. So it requires time. Time is your first thing. Second is the quantum that you want to invest in terms of what the stock should be. And three, deciding that these are probably low risk investments that you can probably. So that would be the order in which I would, want people to look at it. Although, Joseph, let me also add a statutory warning here. In today's world, when you come to investing, price becomes the most definitive term that people use. People like to buy, you tell them a stock is worth 1,200 rupees, it's probably worth that much. But they say, no, show me something at about $150. See if this will go to 5,000 in 3 months. And that's going to happen. There is no harvest that gives you such a bumper crop ever, right? So,
You talked about the 90 days with the different
yeah.
instruments and all of those kinds of stuff. When to exit this short term investment? So, say for example, 90 days is over, I am out, or do I look at some kind of a profit margin and then say, okay, I
Okay.
have reached 10%, 20%, then I exit? How do I
Perfect. Okay.
look at that?
Again, we go back to our ladder of risk. That's why I always go back to the basics. If you're rooted strongly, this is easy to answer. The lowest risk on an instrument is probably the FD. I think we went through that, or a savings bank account. In India, that account offers about maybe 7.5%, 8%, depending on senior citizenship, junior citizenship, whatever. But I think 8%. Now, 8% over a 12-year term. That's what you're going to get, right? Which means when you look at a 90-day period, anything that earns over 8% is fantastic, right? It's
True,
fantastic
true, true.
because you're talking about a quarter. So let's say you earn, for me, even if I look at a 5% growth in a 90-day time frame, you take that for a year, it's about 20%. And that's more than 12% higher than your lowest risk yielding product that you have. So, A, consider the time. B, look at anything even beyond 5% in a 90-day time frame to be a fantastic return. But again, like I said in the previous answer, greed is something that drives all of us, and greed is good. If you probably maintain that greed within limits. Anything within limits is good. Greed is good. So when you get 5%, most of us don't want to get out. We want to run that extra, 1% higher, maybe 2% higher, and that is what draws us into that risk. Sometimes when the markets turn, contentment does not hit us, and we end up making a loss if we let that greed run out of hand. But anything above 5% in 3 months, fantastic.
If greed is not there, you and I will be out of business. So it's good that people are greedy to
Yes,
some
you should
extent.
be greedy. Absolutely. Yes, yes.
Regi, what's the play of fees and brokerage fees in that returns that you're talking about? When you're talking about 5%, what's the impact?
Okay. Okay. Now, in India, Joseph, I mean, we would discuss the US if you want to discuss the international markets. Well, that's a different ball out there. But if you're looking at India per se for an investment, you divide your brokerage houses into two parts, right? One are fintech companies that offer execution capabilities. Now we are talking about these companies that don't offer anything else. They just give you a platform. They just give you, like Riverside FM, for instance. We give you a platform. You want to come, register, do a podcast, go away. Perfect. There are platforms like that which charge very low brokerages, okay, or very low fees. Then there are full service brokers, that charge you a percentage of the volume of the business that you're doing with them. So there are two ways to look at it, right? Now the full service guys are, technically offer you research capability. They might offer you somebody who you want to talk to, maybe a relationship manager, somebody you want to speak to for advice. They send you research reports, all of that free of cost, whatever. The execution only guy is just a platform. So you got to know what to do. You got to learn what you're doing. You got to look at some source to get your information and then do what you have to, because they're not going to offer you research. And if you call them, they're going to charge you for it. So that's an execution. So the execution guys are cheap if you know what you're doing. It's very, very low cost. If you don't know what you're doing and you still need advice, a full service guy is better. Okay, and that, the full service guys normally charge between, let's say, about 0.2 to 0.3% of the total volume of business that you're doing, and that's probably the average. So if you're doing about 100 rupees worth, it will cost you about 0.2% of that to work with. Yeah.
Okay, good. Where do you, the advisory firms like you, where do
Yeah.
you come in? What's the play that you have, and
Okay.
how can you help some of the listeners?
Okay. Now, advisors like us, though that's a term that's becoming very difficult in India right now, because fin influencers, as we are called, are a very dangerous breed today. Because there are guys like in every business, Joseph, you probably understand this better. There are guys who misuse everything. Now, blockchain is good, but using blockchain for the wrong, through crypto, and running a scam out of that is totally wrong. So you have the good and the bad in both sides. So in our business we do that as well. There are influencers who are accused of front running, all this kind. But in our kind of business, I think one of the first things is for clients who have been with us for over a long time. Some of them have been with us for almost 2.5 decades plus. Right now, these are customers who rely on our advice. They don't go anywhere else. They have seen the benefits of having invested with us. They have grown their financial investments over the last so many years. We have done much for them, for their children, now for the third generation investment. This is one breed that we do. So these guys stay with us for a very long time, and they stick to us for advice. The second kind are the people who are probably abroad and overseas, right? NRIs, for instance. Now, the tax regime in this country changes so dynamically. You have the new scheme, you have the old scheme, you have this scheme. So everybody's lost. Even the accountants are lost. Even we are lost. Everybody's lost for some time. So they need a lot of investment advice that comes in, and the returns here are far superior to what probably any other country in the world can offer. So they come back. So we have NRI people based abroad who can come back and invest. The third are the neo investors that we're looking at. We're looking post pandemic. We have that sudden surge from the younger generation, the 20 something, which is the average age 26 or so is the average age of the investor coming in. 30 years ago, when I got into this line, Joseph, the average age would have been 44 or 42. Today it's 26, almost half of that. Now, these guys uh, like to listen to your advice, but they're very conscious about the cost. So they go to an execution only platform. They don't like us. We help them open the accounts because I go to schools, I go to colleges and do literacy programs. So right from MBA classes, right from graduate programs to IT companies, we do these on a frequent basis. Financial education, as we call it. So they listen to us, they open an account or they go online and open an account today and then use their contemporary peer groups to decide on what investment is good and bad. They don't go back to anybody for advice because advice in today's world is a bad word. Nobody likes advice. If I tell you, Joseph, let me give you a bit of advice, you're probably going to shut me down from this podcast, right? So we don't like the word advice. This generation doesn't like that term. So we got to call it something else. And this guy says, no, I'd rather listen to my friend. I listen to my peer. And we have enough instances of that where guys have done it and then come back to us, Joseph, for actually doing what they have to do. But that's a learning curve. So we fit into that, which are, we sort of put the execution capability into the hand of the investor, but we offer the advice on what he needs to execute and transact his money with. And that is where we try to bridge it. And trust me, that universe is growing in a big way in this country.
Absolutely, absolutely. You touched upon the tax regimes
Yeah.
that is changing all the time. So
Yeah.
I know it changes all the time. I mean, you have
Yeah.
already said
Yeah.
it.
Yeah.
But how can we be tax efficient when we are talking about these investments?
Yeah. Again, oxymoron. Tax and efficiency don't go together. Efficient for the government, inefficient for us, right? All right. Now, let's look at it this way. Since the topic of today's podcast is short term, Joseph, right?
Yeah.
There is no efficiency attached to short term taxation in this country, at least in India. Every short term, when I say short term, it means any transaction, profit or loss, done within a period of 365 days has got no tax efficiency attached to it. So you are going to be taxable at the slab that you're probably paying your taxes at. So you have various slabs. Old scheme slabs are different, new scheme slabs are different. And then these come under the purview of short-term gains or losses, as the case may be, right? So whether it is 100 rupee gain you make or a lakh of rupees that you make in a short term, cumulative for the year, you're going to be taxed, and there is no way you can efficiently manage that. You have to pay your taxes on that, irrespective of what comes. Since it's short now, long-term play is different, right?
Yes.
So for the
Yes.
short term,
Absolutely.
tax efficiency does not work at all. You have to pay.
Okay. Diversification is one thing that comes in all the
Yeah.
time about investments.
Right.
Is it applicable in the short term investment? Do we
Yes.
diversify like some of the instruments that you talked about? Some bit on maybe FD, some bit on savings. So do we diversify for short term, or what would your advice be?
Now, the concept of short term, Joseph, is that people look at it more as a lottery. You know, they say, look, let me. Okay, Reggie is telling me this today. Let's go scratch the surface of this stock, see if there is luck written inside that, and I'm probably going to make money. So most of our investors, or any investor for that matter, initially starts out short term as a lottery. But yes, diversification would be the best thing at any stage, whether it is short term, medium term, long term, it doesn't matter. But I think you ought to diversify. It's a simple lesson I think we derive from life. It's like driving a car.
Mm.
You don't drive at the same speed all the time, right? You have highways that can take you at 120. You have city roads where you can't go beyond 25. So you have to learn multiple skills to drive. And you have noise that's coming in terms of two-wheelers and interference that comes. The same thing happens with investment, right? So if you got, let's say, X amount of money that you want to look at for the short term, you can look at maybe 30 to 40% of that for the short term, but 60% of it diversified into medium term. I'm not saying go long term, but into medium term, which means you can probably stretch that into the 6 month or the 9 month period rather than putting everything into the 3 month period like a lottery. And that will give you diversification. Yes, some of it you must set apart for that term, some of it for this term. That becomes more efficient. Like we always say, don't put all your eggs into one basket. Applies here as well.
Okay, wonderful. You have been in this business for more than 2 decades. What are the common mistakes that you've seen people do?
Uh, One of the most common things that I find is to go with the noise in the market. I think this is
Mm.
primary. The media today is. I'm not against the media. We need the media. We are in the media business as well. So, so we need the media. But media does a lot of things for eyeballs, right?
Mm. Mm.
For instance, right now there was an article which came about recently about somebody who was trading on the Bombay Stock Exchange on the BSE Sensex futures. We call that a fat finger error. A fat finger error. A fat finger error is where he adds a couple of zeros more than the number of trades or the volume of the trade that he wants to do. The guy caused an abnormal movement in the price of a particular instrument, and the loss that accrued to him out of that was 78 lakhs. And this was over in a matter of minutes. Okay, this happened last Friday. You could actually verify. We call this the fat finger error. Now, when somebody reads this, okay, that guy who created the error lost 78 lakhs.
Mm.
But somebody's obviously made that 78 lakhs because in the end of the day, this is zero sum.
Mm. Mm. Mm.
It's somebody's loss that's coming to me because I'm buying and selling with somebody, not with the
Mm.
exchange.
Mm.
I'm
Mm.
through the exchange because they're the
Mm.
facilitator. But there has to be a Joseph buying for the Regi to sell, and there has to be a
Mm.
Regi buying for the Joseph to sell. So,
Mm.
it's an exchange process. So
Mm.
somebody has made that 78 lakhs, so there are people
Mm.
who made 78 lakhs. Now, this is going to tickle people's minds. They say, good, now this is like damn good. So let's get back into that business. Okay. So the media puts this out, and then, it's a warning technically, but we still get into that. The second thing, of course, is listening to too much of noise outside. There are news items of people who come up and say a particular stock, which is not worth even 10 rupees till a few months ago, suddenly moved to 40 rupees.
Mm.
Now that's we call that a penny stock, and when a penny stock begins to move without reason, it's probably much more than what you can probably rationalize. So people run behind that because it's been a fanciful mover. It
Mm.
suddenly gained by 30, 40 rupees in a short time. So let's go chase that stock. So you're going to throw advice to the wind. You're not looking at any research here. You're not looking at the company's strength, but you're just looking at the lottery to make your money. Quick in, quick out, because everything is instant today. We want instant coffee, instant profit, instant noodles, everything is instant. So, so that is the second, listening to noise. The third, of course, is not making a clear plan on how much you want to look at for the short term, how much for the long term.
Mm.
I'm not against short term. I enjoy short term trading because there are bouts, because I like to drive, and there are stretches that I really like to push the vehicle that I drive. All of us do that. There's nothing wrong with it, but for a limited time. You can't drive at 120 all your life, right? Even race drivers don't do that, except for the
Mm.
for the time they're racing on the track. So it's like that, right? If you clear about your plan and say, look, I have X amount of money this year, I'm going to invest this much. Oh, you have a plan with it. 20-30% of it goes to short term. I race, I crash, I make a loss. These things happen. But the 70% of it I need to set aside. Now that is investing.
Mm.
I don't clearly demarcate this. I say I'm all in. No, it's like playing at the casino. I'm all in. No, it's like
Mm.
a game of poker. I'm all in.
Mm.
So you push everything in. If the cards turn the other way or somebody has got a running flash on the other side, your chips are gone and you're going to drain. So not
Mm.
having a clear financial plan is the third biggest risk that I see. And that is where most of us start. We want to make 2 lakhs into 20 lakhs. It can happen. It will happen. But like the agricultural example, you need to give it time to work. If you're going to go by the fat finger example, you could lose your house in the process. So if you don't know how to manage your money and think that this is a quick way to make it, well, that's a challenge. So I think three biggest risks in that order. Yeah.
Thank you, Reggie. You already talked about some of the emerging trends,
Yes. Yes.
EV
Yeah.
and AI
AI.
and everything,
Yeah. Yeah.
and all of those kinds of stuff.
Yeah.
Are there any other emerging trends that you are tracking, especially with respect to India? Say, for example,
Yeah.
defense, healthcare. Are you tracking any of these things?
The day we landed Chandrayaan 3, and we got into the lunar orbit, and the rover actually rolled out on that particular day, Joseph. You can look this out. The stocks that were associated with that lunar landing,
Mm,
companies that were associated with, there were about 8-10 stocks that are listed. There are a lot of them that are unlisted, that are not traded on the markets today. Those stocks for the next few days actually went up by about, let's say, more than 20%.
mm,
Okay, now we are going to the sun. Now we're going to the sun, right? We're not going to land on the sun. We're going to be in a perigee position from the sun. But suddenly, space exploration is becoming very important for India. And we are
mm,
making a lot of that stuff within the country, and that's fantastic. But however, a lot of those companies are not listed in the markets today, right? But I will still believe that space exploration is going to be, something that we can look at. But you need patience to deal with it, because it takes 154 days to reach the solar, that perigee position. It takes about 80-90 days to reach the moon. So even that takes that long. So if you're asking me about short term, even that is 90 days. So incidentally, right? So this is one area that you look at. The second, like perfectly mentioned, defense. Perfectly
mm,
right, right? We are now in a position where we've moved from defense imports to defense exports, right? There are a lot of countries buying stuff from us, whether it's guns or missile tips or whatever. So that's going to be something in a big way. The third, of course, is telecommunication and everything to do with it.
mm,
Whether it's data through mobile phones, whether it's 5G tech, whether it is whatever. I think this is going to be something that's a game changer, because everything about us today is dependent on that technology bit. You pay your money using technology, you make your call using technology, you transact using technology, you order food using technology, so, and you're entertained with technology. So that process of convergence becomes very important, and companies involved with that are technically going to do very well. It's a fantastic trend. Now, convergence with mobility is going
hmm.
to be the next area that I think people should look at. We are still a long way from there,
Yeah.
but that is definitely a trend. And of course, there are some ground rules that you can always invest into. Healthcare, for instance.
Mm,
A population of 1.34, 1.4 billion or more, we're definitely going to have healthcare challenges, right?
mm,
So healthcare is going to be big in this country. Longevity improves, geriatric care. So, there are housing guys who are getting into building geriatric, complexes, for people, for retired people to actually go and live where children are outside. Nobody can manage that. So that is again going to be a trend that's picking up. So healthcare is going to be evergreen, and for such a huge country, Joseph, retail is a blind investment.
mm,
Retailing, anything to do with retailing, whether it's food retailing, whether it's clothes retailing, whether it's jewelry retailing, I think we just keep consuming. The consumption thirst or hunger for a 1.43 billion and growing population is never going to end. So those are growing trends, emerging trends. These are forever emerging trends. So
mm.
you just have to mix and match these. So
Mix and
healthcare,
match.
retail, communication, defense, and stuff like that. Certainly, yes.
Lovely, lovely. Finally, Reggie, this particular financial market is always changing, as you said,
Yeah, yeah, yeah,
ever emerging.
yeah.
How can we stay informed and adapt this our strategy, investment strategy accordingly?
I think you need to do more podcasts like this. I mean, that was a quick one. Anyway, it was off the cuff. But I think staying abreast, even for people like us, it's a huge challenge even for guys in the business. Right?
Hmm.
One of the reasons I moved away from core mechanical engineering into financial engineering was because of the dynamic nature of the business that offers. You
Hmm.
know, what was yesterday is not what it is today, and will not be tomorrow, because something or the other changes. There are geopolitical tensions. There are G20 meets. There is somebody going to the moon. There is an earthquake in some part of the world. There is a
Mm,
drought. You have El Nino. You have a million things. And every single incident, whether we like it or not, impacts financial markets today, whether it is a grain market, whether it's the energy market, whether it is the share market, whether it's a currency and commodity market, or whatever. But the impact of any global event is concurrent and happening as we speak even right now. So there is no one way in which we keep abreast of everything. But I think getting yourself, or every investor must have a fallback advisor that he should have, and I believe so. Somebody that he can trust in, not just somebody who gives him tips. Okay, not somebody who sends him SMS and say, "Buy this stock, you make $1 million." That's not the kind. A guy you can turn to for advice and say, "Look, what's the outlook looking like? What are the macro trends today? What are the micro trends today? What are the changes that are happening that can impact for maybe the next 90 days broadly on a larger scale, on a broader canvas with a bigger brush." If you have somebody like that who can advise you, that's the best way. Well, journals and magazines provide you that information, but don't ever listen to the television channels for financial investing. It's a perfect bad recipe for disaster. I say this because they tell you what has happened, right?
Absolutely.
They don't tell you what is happening. They don't pass on a lot of their insight and outlook into what they're doing, right? They don't give you a perspective of what could happen in the next 90 days. They tell you yesterday this happened, that stock fell, this went up, but they're not going to tell you what's going to happen tomorrow. You need to get hold of a trusted relationship manager, bar advisor, somebody. The best, of course, Joseph, managing money is everybody's business.
Yeah.
What I say is going to be to the dislike of many financial advisors, but I think there is nothing very complex about it, right? There's nothing very complex. It's one of the most simplest things in the world. Just that we put terms into it and make it, look like it's some rocket science. It's not like that. I think all of us need, and I think as an education process, the change has to happen from that level. Life skills. It's like swimming. Like how you need to swim, like how you learn to drive. Learning to manage money should be inculcated from very young age, because if that happens, as you grow, you just grow into it by yourself. Nobody teaches us. If you learn to swim, you can probably swim anywhere. You'll survive, and you'll know probably things that you need to watch and look for. So either you get a relationship advisor that you can trust, and probably create a change in the ecosystem at large, where we start educating and inculcating financial skills, so that as they grow, the interest towards keeping that on the top of the game, to be at the top of the game, always grows with them naturally.
I ask three rapid fire questions to all my
Sure,
guests.
sure.
The first one: what is the kindest thing anyone has done for you?
Probably taught me what I knew today.
This podcast is about leadership.
Yes.
In that sense, can you please share what you think as the best leadership quality and who has manifested in your life?
Well, I've had two fantastic bosses. I've lived with two fantastic bosses, and fortunately for me, both of them share the same birthday. Now that's a very unique thing.
Yes.
On this, and it is also coincides with my dad's birthday, the 7th of July. Um, uh, the first guy taught me, the first leader that I worked with abroad, taught me the importance of what a team should be like. You know, how a team should be forged and built. I was much younger, 20 years ago, 25 years ago, much younger in a foreign land, but I think he took me under the wings. He was a Singaporean, taught me the way a team should be built. So forging a team, making a great leader, learning it on the ground in the financial business is something that's it's very difficult. People don't share secrets very easily. The second leader that I worked with was back home in India. I served with that company for about 17 years. He gave me the latitude. He trusted my decisions. He was, looking at me with a microscope when I joined. But over the years, the first 3, 4 years were like that. But after that, gave me the latitude to experiment and expand. I think today, if we are what we are today, it was a combination of those three skills as leaders that put me into where I am today. And trust me, Joseph, what I have learned from them is what helped me build a team that has stayed with me for the last 20 years. Okay, I have not changed this team ever. People have come and gone, but the core team of it, I think about 15 of us, have stayed together for the last 20 years. Evolved from the learning that I took back from those two leaders who I had, fortunately, at the start of my career.
Finally, Regi, what's your definition of living a good life?
I think family matters the most. I think you have a good supportive family. That's point number one. Living a good life is not just about money, but it's being comfortable and learning how to use that money to give you the goodness that you want, right? I think that's more important. Money is an important and integral part of life. So since we're doing a podcast on money management, and you asked me, what is living a good life, I think that is more important. If you're able to provide for your family, if you're able to invest, bring about returns that help you and your family be more comfortable with what you have. I'm not saying don't aspire, you must aspire, but if you're able to provide for that and be content, coming from a financial advisor, contentment, like I said, I started with greed, I'm ending with contentment. But I think you need to find, they're again opposites, but you still need to find contentment within that greed. And if you're able to balance that out, Joseph, I think you've got the best of your life ever.
Regi, thank you so much. That's a fantastic, fine place to end this particular conversation. We started
Perfect.
with greed,
Yeah,
we
ended with
finished with
contentment. Yeah.
contentment. Wonderful. I hope you enjoyed our conversation. Can I request you to share the key takeaways from our conversation? If you like the conversation, please share it with others. Have a life of wins.